And of course, what also happened, which brings us back to gold, and I will be tying, once I've taken you for a little bit of a walk in the wilderness, I'll be tying this all back. Gold ran, having done our target of 2,900 and 3,000 that we had suggested when we were down at 2,000 on your channel. Gold had a surge from the 2,900, smashed right up to 3,500. And that was its peak. And then we got put into an April till September continuation pattern that recently broke out and led to the 3,350 runs right the way through for another $1,000 to the high end of 4,350s. And since then, we're having our pullback. But going back to that April moment that was super, super violent, what was really behind that? We called it peak Trump tariff tantrum. And the great irony about that is Donald Trump came out and said, without being prompted, I don't know how this came out, but ended up saying,
"Today, Francis Hunt discusses how the system's excessive leverage magnifies every market movement, how central banks' interventions disguise rather than eliminate risk, and why abrupt changes in the financing and treasury markets can have an impact on stocks, currencies, and precious metals." Hunt cautions that what seems to be stability could actually be the quiet before a catastrophic liquidity shock, where forced deleveraging causes abrupt, non-linear market reactions. Understanding those red flags before they make headlines is the focus of this episode. Hunt's concept links technical market behavior to actual results, such as failing auctions and collapsing bond spreads, as well as rising gold demand and declining fiat confidence. As you listen, consider the three foundations of the contemporary financial system: money, collateral, and confidence. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets. We'd love to hear your predictions. Drop a comment below.
Can you expand on that and how the Cayman Islands plays in with this as well?
It's an incredible story, Elijah, and like you, I have my suspicions. As much as I don't wish any ill on America, I have my suspicions surrounding people that comment about robust, a great auction for treasuries again today. You get a lot of this, all these people talking about, the dollar's under threat. Look how well demanded the treasuries have been, et cetera, et cetera. And there's been recent revelations, but it's worth also putting why these recent revelations have come out. There was an event in April that was very specific to the gold market, and I'll tie all this back to gold because I don't want people to think that we're just going on a journey in the wilderness here. This is a gold story in the end, and a silver story, very, very strongly so. In April, at what we called and named peak Trump tariff tantrum, which was when the very first time he was getting super aggressive and levied triple-digit type tariffs across the broad spectrum of nations, but the ones on China being probably the most significant due to the trade relationship that is held there. We ended up getting an event that saw treasuries spike down in value, rates spike disproportionately up. And I will show you that event on the charts when we refer to the technical section in the second half of our chat. But I want to put that landmark for everyone to remember. And of course, what also happened, which brings us back to gold, and I will be tying, once I've taken you for a little bit of a walk in the wilderness, I'll be tying this all back. Gold ran, having done our target of 2,900 and 3,000 that we had suggested when we were down at 2,000 on your channel. Gold had a surge from the 2,900, smashed right up to 3,500. And that was its peak. And then we got put into an April till September continuation pattern that recently broke out and led to the 3,350 runs right the way through for another $1,000 to the high end of 4,350s. And since then, we're having our pullback. But going back to that April moment that was super, super violent, what was really behind that? We called it peak Trump tariff tantrum. And the great irony about that is Donald Trump came out and said, without being prompted, I don't know how this came out, but ended up saying, we weren't worried about the bond market. Now, what's happened since then is the Bank of International Settlements, which for those that aren't familiar, is a Swiss-based central bank to all central banks, highlighted that there is a crowding out and real systemic risk brought about by a very crowded trade, a very highly leveraged crowded trade. And that trade is what's known as the basis trade. So a top line, everyday man's explanation of the basis trade without losing ourselves too much in fin speak and gobbledygook jargon is basically the following. Leveraged hedge funds buy treasuries. They do so with great leverage, so they're typically putting 1% and 2% maximum down. They are being levered up, essentially 100x, and are holding this. They are then pledging it as collateral, and then they are securing further leverage. They are shorting the futures markets, which typically trade higher than futures are basically, particularly on bonds. It's just fiat, but it's fiat with a delayed delivery. So it's all about fiat. Even debt markets aren't really debt markets, they're fiat markets. We say we merge the two back together. They're Siamese twins, but they're one and the same. But it's just delayed delivery fiat, a bond. That's all it is, with a maintenance cost. So in essence, they are shorting futures on the basis by the time the expiry comes, the futures typically come back down and meet spot on delivery day. There's no point in buying a more expensive future for delivery the same day if you can buy a spot cheaper. So invariably they come down. So they're shorting the higher line that comes down and buying the undervalued asset. So many will say, well, technically they hedged because they're long the same assets that they are short. The problem comes in is most markets have what's called contango. That means the future delivery costs more than the present ownership. There's in things like gold and oil, obviously there's storage costs. When you're talking about paper money that is all digitized, it's more about opportunity cost and also interest rate costs and maybe a little bit of inflation that creeps in there as well, being priced in. So they are getting a very meager return. It's not a great trade. Particularly, it's a very meager return. How do you maximize a meager return? You apply a huge amount of leverage on it. But there's also costs, and in the financial running of this basis trade system, they are pledging the collateral. They're even letting go of ownership for it for a while and financing with the repo markets, which brings in the intricate plumbing. Repo markets are the interbank lending, where excess deposits can be lent to other banks at a low liquidity levels overnight just to shore up a short-term cash need. So you have all of this interbank plumbing that typically doesn't affect you and me in the streets. Of course, it also extends into money markets. Now, just an aside, not specific to the basis trade, Warren Buffett is getting a lot of attention for having one of the biggest holdings in the money markets. I think he has in excess of 300 billion in the money markets, where he's earning around 4%, possibly a bit more, on that on an ongoing basis because he's unhappy with equity valuations. So he is providing liquidity technically via the money markets for interbank lending. His bank can make up those excess deposits available to other banks that might be short. And all of this is a funding mechanism for aggressively levered through the primary dealers who are facilitating the hedge funds for putting this trade on.
Following from Hunt's primary thesis, the most important lesson is how an overcrowded basis trade transforms routine treasury issuance into a significant liquidity risk. To put it simply, big funds use borrowed funds to purchase treasury bonds, frequently with very little cash down, and then use those same bonds as collateral for more borrowing. The safety buffer of the system is eliminated by this chain of leverage. The warning flags are simple to spot. Keep an eye out for concentrated treasury holdings in a small number of locations, tighter haircuts, and rising repo rates. These indicators indicate an increase in stress. Because capital frequently rushes toward hard assets as a hedge, this has two implications for investors in precious metals. Gold and silver can rise dramatically during times of abrupt stress as they reclaim their position as safe havens. In the long run, higher real prices for physical metals are supported by ongoing debt accumulation and recurrent liquidity problems. Therefore, short-term declines shouldn't be interpreted as a sign of weakness because they are frequently merely pauses in a broader transition toward a society in which material possessions are the true source of trust. Now, let's get back and hear his following words.
It was only 25% of the position they truly had. In other words, 4x the true value. So here you have a tiny Caribbean island. You're talking about a speck of an island that has 7.1 billion as of 2023 GDP. Now, let's just say 7.1 billion GDP is the equivalent to a man's income for a year. If you were on 250,000 a year, Elijah, you would have, and you were the Cayman Islands, so your 250,000 is equivalent to 7.13 billion. They have 1.8 trillion in US Treasury exposure. That would be the same as you, with your $250,000 annual gross salary, having 68 million bond portfolio. Now, I think you would be thinking that if you were on that income, you might have a bit of gold, you might have a silver. It would be quite unlikely that you'd be deep in the 7 digits on anything on $250,000. You have a bond to pay, you have other expenses, etc. on $250,000. But 68 million bond portfolio is deeply improbable. with that level of income. That is the scale to which the Cayman Islands has become this bottomless pit buyer of what I consider to be Ponzi-onomics, which is 1 trillion every 2 months. We've just crossed into 38. It was 2 months ago, we crossed into 37, and it's escalating. We will be 40 trillion before the year end. It starts with a 4. And who are these big buyers? They are being financed by repos, overnight, daily repo funding and the money market system. And it's a crowded trade. And all you need is for futures to go into backwardization instead of contango. They are so leveraged and they consider it such a certainty. And they've all been jumping into the space and getting these returns. You just get the future move away from the cash markets, and they will not have the margin to hold it up. It becomes systemic, too big to fail. Fed has to stand in. It's a long-term capital markets parallel as well, because they put the entire system at risk, and therefore you create the next bailouts for. It's not even for retail. Socialized cost on the rest of us, major profits. The people who will gain out of this folly, though, and how do we ensure ourselves, is gold. The point at which we had this event in April, it's worth showing you what gold did when all of this had its wobble. That has led to all these recent exposures that we are now discussing. It was this period here that saw this huge run-up. Doesn't look huge now, given what's happened since. But we had a surge from the 2.9s to 3.5. $600 on $2,900. That was literally a 20% move, and they quickly went into mini behind-the-scenes crisis. Many of people aren't even familiar that much was going on, but Trump did make that rather telling statement. Did you have concerns about the bond markets? It's worth also showing you what the benchmark US 10-year did, of which housing finance is so reliant on, Elijah. That was this period. You should see it immediately pop. This was gold at 2,900, bang, gold at 3,500. And as much as there's been talk of cuts and everything is recessional and soft, which it is, in my opinion, you have yet to make the pre-basis trade wobble lows. We've been in a long, slow comeback with terrible news on employment. We've had some shocker non-farms. We didn't get a non-farm because of closure last month, but before it, we had 2 in a row, very, very hard hits. You've had Trump putting pressure on all of that. You have yet to get back to the rate level on 10-year treasuries that you were at here just prior to the basis trade wobble. So this just goes to show the sensitivity.
Francis Hunt concludes his research with a potent cautionary tale that connects the unseen mechanics of debt, leverage, and the abrupt fluctuations of gold. He starts by using the Cayman Islands as an example to show how ridiculously stretched the system has become. Despite having a GDP of barely $7 billion, this tiny Caribbean country manages to maintain roughly $2 trillion in U.S. Treasury exposure. Hunt compares this to someone who makes $250,000 a year and manages to accumulate a $68 million bond portfolio, which is an obvious indication that something strange is causing this kind of purchasing. Hunt refers to this leverage as the basis trade bubble. Funds are borrowing enormous amounts of money overnight to purchase government debt in the hopes of making consistent returns from little variations in futures and cash prices. However, the system may see immediate margin calls and forced liquidations if the market flips, futures fall into backwardation, or short-term rates soar. The Federal Reserve would then be forced to step in, as it has done in earlier crises. Once more, the benefits from this careless leverage would remain private, but the costs would be shared. Hunt cites previous market responses as an indication of potential future developments. Gold surged from $2,900 to $3,500 in a handful of days during the most recent significant volatility, despite treasuries declining and the currency dramatically declining. Few people knew what was going on behind the scenes during this quiet crisis, but it showed how easily confidence may crumble. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.